Alright. Hello. Um, Today's focus is going to be based on the previous video I uploaded, talking about the first presentation fair value gap, and I'm actually going to make the executive decision, to cut this one a little short, even though I want to talk about a few more things. I'm going to only focus on the daily chart, a little bit of what's going on in the markets, and mostly just focusing on the 1 minute first presentation fair value gap. So here we are on the NQM 2025 chart. This is futures, but you can look at the QQQ if you want, which is the NASDAQ Composite Index. So it is 12:12 a.m. currently, and I'm exhausted, so I'm just gonna get straight into it and talk about the daily chart real quick. So as you can see, from Tuesday to Wednesday's trading, we gapped up a significant amount, enough to constitute it as a large opening range gap from the regular RTH close to the RTH open. And so relative to the IPTA dealing range on a 20-day, it was extremely bullish, extremely bullish of a gap. And so we were basically, if you take your IPTA dealing range for Wednesday's trading and use this as day 1, count back 20 candles, and this as day 20, we have these two highs, 524 and 536. So we take this candle's high all the way down to this low, and equilibrium was just a little bit below that candle's high. So this candle goes up, hits it, and bounces a little bit, retraces a little bit. So next day we gap up under the premise of a tariff cool down or U-turn. And so it was more of a news event that caused that type of gap, but all technicals aligned. So that's pretty beautiful. Volume imbalance right here, and you can see how we went up into that volume imbalance and above it, but failed to close like a body, right? Or sorry, we have a little gap opening, but the body comes back in and closes inside of that volume imbalance. And so the main point I'm trying to get across here is the IPTA dealing range. So take that, look at that, study that on your chart, and for a longer term move, I do think we have space back up into this fair value gap from March 10th in the form of a SIBI. So that is a daily chart for you. And going straight into the 1 minute, it's going to be extremely clustered, but I'll break things down, remove some things. Well, actually I won't. I'm just going to keep it here. Just go with the flow. So I'm only going to show just about here for the chart, no particular reason. And I'll look back till 6 a.m., right? So 6 a.m. was about when I started. It was 6:30 when I started looking at price, and I was just kind of warming up to it. But then 7 a.m. I mark these initial buy side liquidity and initial sell side, which is minor sell side and minor buy side, but that's what I annotated as, and I left it just because I wanted this sort of marking. I didn't want a trend line, if that makes sense. That'll make more sense later because I have my presets all saved, so I kept it to this, and I'm keeping it to that for the recording. So at 7 a.m. I started to begin hunting for highs and lows, and I didn't see any relative equal highs or lows in vicinity except for these. So we do have that 1 minute initial buy side liquidity at 6:55 a.m., which is a short-term high. And then we have the initial sell side liquidity at 6:51 a.m. So that is annotated as IBL and ISL. Fast forward to 7:30 over here. So 7:30, we close that candle, and I look back the previous 30 minutes to see where is the buy side resting and where is the sell side resting in that previous 30-minute candle. So you can see that's annotated in the form of this high and this low. So we have 1 minute buy side liquidity at 7:05 a.m. and 1 minute sell side at 7:30 a.m. So that gives us a pretty nice little range to be working with. Now the question I'm asking myself here is not really related to the daily chart, but at the time I did happen to have looked at the daily chart, and so I did feel it was fair to draw higher. And so then I started watching these highs. I favored these highs, and I allowed price to just work at this low. And so I wasn't worried, I wasn't affected by these lower lows. I didn't think we were going to go lower at the moment. I was more so focused on this particular high because I liked how the sort of middle of the range, this was kind of treated as a middle of the range for me, or I was treating it as a middle of the range, and I liked how we worked into it, made these kind of jagged highs over here above this high, and then we just quickly left it, and then we started to work down here and make these lows jagged, and then we had obviously these equal lows here, right? So nice liquidity there, coupled with a buy side imbalance, sell side inefficiency, extend that out in time, but the main thing that I was using at the time was this low. Okay, so then we have this 7:35 a.m. first presentation fair value gap, first presented fair value gap, and while you'll notice right here I have it from this low, then there's a candle right here to this high, so there's two candles in between. The reason I did that was because there was this gap over here, so I didn't want to use this candle just as the gap, right, from this low to that low high, from this candle's high to that candle's low. It was too small for me, so I incorporated both. That's what I prefer to do. And so I allow for some flexibility during live trading, but in terms of backtesting, if I had to choose one, it would be from this candle's high to this candle's low. So that's thinking from more of a algorithmic procedure, unless the code is very complex, not very complex, but if it incorporates this sort of formation here. All right, and so you can see that gap, once it closes above it here, actually here the close is 18,891.50, and the high is 18,891 and a quarter. So closes above here, treats it as inversion. So pretty nice to see that. You can see that there's some respect on the closes. So once again, going back to yesterday's lecture, or the previous lecture, or video, and then I'm watching it trade up into this range, trades up into there, sort of consolidates a little at the low end of that range, and then bumps up into those highs. 830, you can see we have the 1 minute first presented fair value gap, and same thing at 830. I'm looking back and seeing, okay, in the previous 30 minutes, where is the high and where is the low? And so we had the low here, but you can see that that low, at the time, it did not look like it was the next draw. I preferred this one, and that was because we had this little low here that was just, it was clean. It was a quick spike into that, and it was like a raid on liquidity, raid on sell stops, trades lower here, and then so the damage has been done here. This is still smooth, and you can see they attack this high and this high, and then we have 838 right here. That's when the high is traded to. So now fast forward a little bit more, and we still have not reached the 930 opening. Okay, so we're still all pre-market trading basically. So trade higher, 858, we price in the high, and then we drastically trade all the way down lower, back into the 831 AM first presentation fair value gap, and then back into the 735 AM first presentation fair value gap. So what I'm looking at is we had liquidity cleared here, and we had liquidity cleared here. So we have a new dealing range that we can use for a trade, essentially, for a premium discount if you're taking a trade. And so taking that and drawing it from the 8:58 AM high to the 9:09 AM low. And it might be a little too dark, but color scheme is not great. But you get the point. We have equilibrium right here. We have that old buy side right here. So you can use that as a sort of key intraday level, and you can see how price trades back above the 831 AM fair value gap into the equilibrium, closes above it, this gap, closes above this gap, trades into the equilibrium, and then starts to expand up higher, attacking this high. Okay, so we continue forward, and then you see that despite, and I'm just going to bring this back over here. Okay, so just using now all the stuff that we have on the chart. So I'm going to zoom in. So we're focused on this dealing range, okay? And now, focusing on this dealing range before the 9:30 AM opening, we did have this buy side all the way above here. 1 minute buy side liquidity at 12:26 PM, but this is actually anchored on a 1 hour chart. So I didn't go on a 1 minute chart and like I didn't go on a 1 minute chart, go all the way back to 4:15 and find this liquidity. I went on an hourly chart, figured what was clean on an hourly chart and smooth, and then I found that high. I put it down on that 12 p.m. candle, and then I went to a 1 hour chart, and I went specifically to that lunch hour, and I liked how it was the lunch hour that we priced in that high, meaning like where we left those smooth highs, because that means there's lots of trailed stops there. So it all lended well to an idea of it trading higher. And so you can see 9:30, we we have that right here. 9:30, trade into that buy side, work a little higher, and then things start to get a little rough here, a little volatile, and a little whiplash back and forth. But with the benefit of hindsight, things do pan out pretty nice. The first presentation fair value gap, I'm going to remove this, but you can see how even though we worked above that dealing range, it still works perfectly. And it's cleaner on the ES, which I was going to do an ES analysis. I even have my notes here, but I'm way too exhausted to do so. So I am going to focus more on getting rest rather than putting out dead content. I feel very tired right now, so basically just going to finish up this NQ and then sleep. So anyways, here is the dealing range. We have equilibrium right here. Even though we worked up into it, it does not cancel it. You can use that dealing range. Price comes back in the equilibrium, back inside that 1 minute 6:55, or I'll just say pre 7 a.m. short-term low, short-term high, which has this, it's a beautiful range in my opinion, and you'll see that it's used throughout a lot of the day. So I'm going to turn this off for now to clear things up, and I'm also just going to turn this off, and I'll keep everything else. Okay, so we have the draw here, and we have 9:30 opening. I drew this first presented fair value gap just because there was no gap around 9:35. Like 9:34 is when I saw it. And then we did eventually form this gap over here at 9:35. But I was getting a little impatient, if I'm being honest. So I wanted to see how we trade with that volume imbalance in respect to this, considering that this was in a premium relative to the 1 minute pre 7 a.m. short-term high, short-term low range. I would have preferred to see it inside of that, or not really inside of it, but like even below it. So I was just kind of studying to see how does price react to that. And then we traded below it, and then I saw this wick trade lower right here. This wick traded lower, and then we had an immediate reaction off that range, which I was kind of very glad to see that reaction and how fast we drew. But at this point, I'm becoming aware of the fact that price is sort of, what's the best word? Dangerous. It's dangerous. It's a dangerous environment. So coupled with the fact that I do have notifications on for ICT's Telegram, and even he was saying so. So it was just creating some caution for me. If I was going to do anything, I was going to do it with a light hand, and being very nimble, not asking for too much. And I'm glad I did so. So I'll explain in a second. Fast forward here. Okay. And as you can see, we did price in a new high, where here, I'll just throw this in here. If you were watching ICT's Telegram, if you were watching this live, he called initially this rejection block. He did call this first presented fair value gap, which I already had marked on my chart. So usually I just treat this with the idea or expectation that, you know, what it's formed as is always ready to change, meaning it could be inversion, it could be the actual function of it, like it's a SIBI, but in this example it became inversion. And then I'm also completely aware of the fact that it can reclaim it at any time. So I'm kind of like looking at all three aspects of the gap that I know of. So yeah. Anyways, came up here, took this high. I would have wanted to see it trade lower and close in this inefficiency, because we had this gap right here in price at 952, which I'm noticing, which I noticed at the time, and I'm mentioning this now. This is the first gap of the 950 macro. So I don't know what importance that holds, but that's something that I am going to be studying, that I write down on a notepad and I keep it in mind at all times. So when I go in my back testing, I back test it to eventually forward test it. So that's how I do things. And so yeah. Anyways, first gap of the 950 macro. And when I'm saying that, I don't mean that it's like super important. I feel like that's how it comes off, but that's not the impression that I want to give. It's just my log. This is my log. So I would remember this as the first gap of the 950 macro that I utilized. And we had this order block here with a sweep of liquidity here and a draw lower with this first presentation remaining portion that we technically, the way I saw it is, even though this is a sell side imbalance, we traded lower and then we ran through it. We still had this gap right here, but I was essentially looking at this first presentation fair value gap just because that's what my eye drew to, is this huge white thing, but this white like rectangle. But if you remove this, what I'm really talking about is this. And I would do a discount because that's not the first presentation fair value gap. And then we traded, down below the consequent encroachment. So I would move this over here. And this portion is what I'm talking about. And I'm going to leave that there because eventually it does go into that, just at a much later time. So you can see 954 trades up into that. I took a short, traded lower, and as we are trading lower on this candle, now because I am doing options at this current time and this in this market environment, I'm actually going to pull up the orders on my phone here, and I prefer to do options on my phone, but let me give the exact times, because I like to give exacts, not here and there. So the exact numbers is, while I was looking at the NQ, I was trading the ES, or the SPY SPY. So I did SPY 543 puts for April 25th expirations. I took one contract at an average price of 606 and order filled at 423. So the date is 4/23/2025 at 9:54 and 14 seconds. Right? That's the fill. Okay, and then the next, I sold it at 9:55:03 Eastern time. This is all Eastern time. You can see matches up right here. 9:55. We're going lower. And on the 3rd second of that minute, I sold it at an average price of 647. Same contract, of course. And so yeah, very nimble. Very happy with that, because look at the reaction we had after. And then we had the 10 a.m. news, which I'm so blessed that I did not participate for that. So yeah, price action was, in hindsight, good, but in the moment, it was a tough read. Yeah, sorry. I did a lot of training with my dog, so that noise is just, what I just did was just habitual. Anyways, fast forward, focusing on this gap, Anything else that I can remember, we do have buy side here. It does have the option to work up here, essentially. But I wouldn't want to see it work above this high anymore. So this is obviously with the benefit of hindsight, but I'm training my eye, I'm training my brain. And so you can go, and I might be wrong, honestly, it could, but I don't remember off the top of my head. Yes, so there we go, trades above that high. So now what I do is I treat this as a draw on liquidity, and then as soon as we trade to 1030, right here, 1030, then we have 1031, no gap, 32, 33, the first gap comes over here, and I treat that as inversion. If I was watching this real time, boom, treat that as inversion. I like how it's above that high, actually. You can see, using that as inversion, continues. Oops. There we go, zooming out. Continue. And eventually we do meet that right there, but at a much later time. So imagine holding from this gap, expecting a draw within the next candle or two, and having to wait. Let's look at this. Having to wait an extra 1 hour and 29 minutes. So I'm glad with my decision making today. And you can see how the first presentation fair value gaps are not used as necessarily trade entries, although they can be, but they're more so used as a means of measurement. So you can see that the volume imbalance right here at 954. So this is the first volume imbalance of the 950 macro. You can see the precision right there. But I'm not really like watching those things real time. I'm focusing more on the gaps, and so I had that only there because that was an ICT sponsored, and right here I have it in my notes, ICT. So that's not a level that I really look at. It's more so a level that ICT was looking at. But I study these because they're called out. So typically it would just be this gap that I would look at, and this volume imbalance would go, if I'm being honest, unnoticed. But now, because it's something added to the log, I did notice, and like my observation here is that that is the first volume imbalance of the 950 to 1010 macro. So yeah, if I'm not missing anything else, obviously market comes back down into this range here, and if we take that dealing range back, that one right here, there you go. You can see how eventually the market does work in that, and I'm going to remove that. Market does work that dealing range quite well, not breaking the high of it. So it shows respect to that dealing range. Pretty cool, huh? Right? So I'm going to call that a wrap. It's getting kind of late now. 12:39. I'm going to call that wraps, and I'm going to get this uploaded to you. Peace.